What if I told you that your bank, your government, and the entire financial system aren't just failing to help you, they are actively engineered to keep you broke, borrowing, and tethered to a desk until the day you die? That sounds like a conspiracy theory, right? But let's look at the receipts. As of early 2026, the average American is now carrying over $105,000 in personal debt, while the U.S. national debt has rocketed past $35 trillion. That's not just a number on a screen, it's a claim on your future labor and your children's freedom. Here is the shocking truth nobody mentions. The system doesn't just tolerate your debt, it requires it. Without your monthly interest payments, the entire global banking architecture would collapse in 24 hours. You aren't a customer to them. You are the yield. Today, we are ripping the curtain wide open on the debt trap architecture. I'm going to show you the 3 invisible strings they use to pull you back every time you try to get ahead, and more importantly, the one strategic exit that 99% of people are too afraid to take.
Stay locked in until the very end, because once you see the glitch in how money is created, you will never look at your paycheck the same way again. This isn't just a video, it's your eviction notice from the rat race. Let's break the cycle. Let me ask you something brutally honest. Why is it that you work harder every single year? Longer hours, extra shifts, side hustles, and yet the financial pressure never seems to go away? Why does it feel like no matter how much you earn, there is always a bill, always a balance, always something pulling you back under? You are not lazy, you are not stupid, and you are definitely not alone. In 2026, the average American household carries over $104,000 in total debt. That includes credit cards, auto loans, student loans, and mortgages. Over $104,000. And here is what makes that number even more disturbing. That figure has climbed every single year for the past 2 decades. Not because people got lazier, but because the system is working exactly as designed. That is what we need to talk about today.
Let's start at the surface, the reality most people call normal. In 2026, debt is treated like oxygen. It's everywhere, and we're told we can't survive without it. You need a car to get to work? You get a loan. You want an education to build a career? You sign away your future with student debt. You want a roof over your head? You commit to a 30-year mortgage. Society has normalized this so deeply that we've stopped questioning the price of admission. We are told that debt is a tool, a stepping stone to the American dream. On the surface, the narrative sounds logical. Why wait 10 years to save when you can have it today with credit? This is the official story. Banks are presented as helpful pillars of the community. Your credit score is marketed as a badge of financial honor. Borrowing is rebranded as smart leverage. Millions of people accept this script without ever looking at the fine print. But I want you to pause and ask yourself 3 inconvenient questions. Why does your bank cheer when you only make the minimum payment? If they really wanted to help you, wouldn't they want you to be debt-free as fast as possible? Why is the credit card company perfectly happy letting you carry a balance for 20 years? Why does the student loan system start charging you interest while you're still in the classroom, before you've earned a single dollar from that degree? The answer is simple, but brutal. These are not accidents. They are design features. The system doesn't want you to pay off your debt. It wants you to service your debt. They don't want your principal. They want your interest forever. And that realization brings us to a much darker layer. Because to the banking system, you aren't just a borrower. You are a perpetual subscription model.
Layer 2. What few people know. Interest is the engine of control. Here's what they do not tell you in school. The entire modern banking system is built on a concept called fractional reserve lending. In plain English, banks do not lend you their money. They lend you money they created the moment you signed the loan agreement. Your signature is the asset. The loan is manufactured, and every single month that you make a payment with interest, you are feeding real wealth, your labor, your time, your life energy, back into a system that created that money from nothing. Let that sink in for a second. In 2026, the Federal Reserve reports that Americans collectively paid over $1.3 trillion in consumer interest charges last year alone. $1.3 trillion. Not paying down debt, just interest, just the cost of being in debt. That is $1.3 trillion that did not go into retirement accounts, investment portfolios, or emergency funds. It went straight to financial institutions. And here is the mechanism that makes this a permanent trap: compound interest.
When it works for you, it is the most powerful wealth-building force on the planet. But when it works against you, it is a financial chain you cannot see, but absolutely feel. A $5,000 credit card balance at 24.99% APR, which is now the national average in 2026, will cost you over $12,000 if you only make minimum payments. You borrowed $5,000. You repay $12,000. The bank invested nothing and collected a 140% return on manufactured money. Why does nobody teach this in school? Because an informed borrower is a dangerous borrower. A dangerous borrower asks questions. A dangerous borrower pays off debt aggressively and stops feeding the machine. And that is a problem for a system that depends on your perpetual indebtedness. Now, before we go to the deepest, most uncomfortable layer of this conversation, I need to ask you something. If this video is already opening your eyes, do me a favor right now. Hit that like button. It tells the algorithm this information matters, and it gets it in front of more people who need to hear it.
And if you are not subscribed yet, hit subscribe and ring the bell, because what we are about to expose next is the part they really do not want you to know. Layer 3. What almost nobody knows. The system is structurally designed for your dependency. All right, here is the deep truth, the thing that almost nobody connects. Why does the government consistently run trillion-dollar deficits? Why does inflation erode your purchasing power every single year without fail? Why do wages grow at a fraction of the rate of asset prices, meaning homes, stocks, and investments? Because the entire macroeconomic system, not just banks, but governments, central banks, and corporations, is built on perpetual debt expansion. Let me explain this clearly. Governments fund their operations partly through borrowing. Central banks, like the Federal Reserve, manage the economy by controlling interest rates and money supply. When the economy slows, they lower rates and print money, which is called quantitative easing. When they print money, the value of every dollar you hold quietly drops. This is inflation. And inflation is not a bug in the system, it is a feature. Why?
Because inflation punishes savers and rewards debtors. When you hold cash in a savings account earning 2% interest, but inflation is running at 3.5%, which is exactly where we sat in early 2026, you are losing 1.5% of your purchasing power every single year just by saving. The bank holds your money, pays you almost nothing, and lends it out at 10 to 20 times that rate. Meanwhile, asset owners, people who own property, stocks, and businesses, watch their net worth rise with inflation while you fall behind. This is how the wealth gap widens every year without anyone pulling a visible lever. And here's the cruelest part of this architecture. The credit score system, the thing that determines whether you can access housing, transportation, and opportunity, is designed to reward you for staying in debt responsibly, not for eliminating debt entirely. Think about that. You are literally scored and ranked based on how well you manage debt. Not how wealthy you are building, not how free you are becoming. How well you stay in the game they built. Someone who has been debt-free for 10 years will often have a lower credit score than someone actively managing multiple credit accounts. Why? Because a debt-free person is not profitable to the system. They are not paying interest. They are not dependent. And a system that needs perpetual borrowers cannot afford for you to be fully free.
Now, let's talk about what you actually do with this information, because knowledge without action is just frustration. 3 actionable tips to break the debt cycle. Tip number 1, attack the highest interest rate debt first using the Debt Avalanche method. List every debt you carry. Identify the one with the highest interest rate. That is usually a credit card. Pay the absolute minimum on everything else. Then throw every single extra dollar at that highest rate debt until it is gone. Then roll that payment into the next highest. This is not exciting, but it is mathematically the fastest way to stop feeding the interest machine. The Debt Avalanche can save the average household over $8,000 in interest compared to random or minimum-only payments. Tip number 2, create a debt freedom account separate from your regular savings.
Save Falling inspirational coach, empowering and uplifting with a steady, reassuring voice. This is a dedicated account, not an emergency fund, not a vacation fund, specifically for accelerating debt payoff. Even $50 extra per month compounded over time creates momentum. The psychological power of watching this account grow is real. It rewires how you think about money. You shift from reactive to strategic. Tip number 3, negotiate your interest rates directly. This is the tip almost nobody uses. Call your credit card companies. Ask them to lower your APR. It sounds too simple to work, but a 2024 consumer finance study found that over 75% of cardholders who called and asked for a rate reduction received one, with an average reduction of 6 percentage points. 6 points. On a $10,000 balance, that is $600 per year back in your pocket instantly with a single phone call. Why are you not doing this right now? Because nobody told you it was possible. Now you know. Now you know the blueprint they never wanted you to see. So here's my challenge to you. Drop a comment below and answer this. Why do you think debt education is not taught in schools? I read every single response. If this video cracked something open for you, share it with one person who needs to hear it. Subscribe to Future Freedom 360 for the full Wise Money system. And next up, watch why your savings account is actually making you poorer. That one hits different. Let's go.